Hi, I'm Pedro da Costa. I'm joined by Simon Johnson, Senior Fellow here at the Peterson Institute for International Economics and Professor at MIT. Thank you for joining me.
Thanks for having me.
So, wanted to talk to you a little bit about Fintech, which is a short term for financial technology. You've been very optimistic about the potential for these new developments to kind of improve perhaps the efficiency of the banking system and even perhaps financial stability. Can you talk a little bit about what promise you see in the developments and what technologies specifically you see as potentially promising?
Well, obviously fintech is a huge area and a very active, fascinating area right now. What I've been drilling down into more, and this is with the colleagues at MIT in particular, is blockchain technology. So the set of technologies that have sort of come out of the space around Bitcoin, they're more decentralized. You can get away from using so-called trusted intermediaries. There's very big applications in clearing and settlement for financial markets, for example. But we think there's a lot of non-financial implications. And interesting enough, just sort of complete the circle, the central banks are also getting interested in what does this mean for the kind of monetary system and the mechanics that you want in any well-functioning monetary system going forward.
Interesting. And so, how would blockchain improve the financial system in practice? And is the idea that you would be basically doing more peer-to-peer lending or business-to-business lending directly because the technology would replace the financial intermediary? Is that where you think we're headed?
Well, let's take it step by step. So first step would be, think about clearing and settlement for securities transactions, for example. This is in the United States. This is extremely complicated. It has many intermediaries, people who have to handle pieces of paper or what are essentially pieces of paper at this stage. And it also has many points of failure where each one of them, if it fails, creates ripple effects and damaging consequences. And we saw some of that in the financial crisis in 2008, for example. And there were also many worries about, if this goes down, this other piece goes down, the consequences would be terrible. And that, of course, brought in all kinds of government assistance. So if you're building a more robust architecture and one that's more decentralized, think of it as having more backups. And think of it like the internet, actually, in this sense that if one computer or even one fairly large part of the internet goes down, the traffic gets rerouted and you probably don't notice at all, actually, these days. So building that kind of market infrastructure and when you're doing that, you also have a better and more efficient way to handle these transactions. It's just data. After all, it's digital. There are some very specific security and other requirements around high value data like financial transactions, but that can all be handled as we redesign and roll out this new kind of system. So I'd say the big picture, Pedro, is you get more robust, stronger, and if we do it right, more secure financial architecture for the United States, for other developed countries, but this should also be available for emerging markets. It should also be available for any country at any level of income. So I think that's extremely constructive.
Interesting. And so how did the central bankers see themselves as fitting into this picture? Because, they clearly, I feel like in the beginning when I talked to Federal Reserve officials and economists about Bitcoin, they would kind of laugh it off when it first appeared. And they suddenly had to become familiar with it as they noticed that the technology had larger applications than simply Bitcoin as a store of value. And the same with Wall Street. It seems like banks are now investing in this technology. So where do the existing players fit into this picture?
Well, banks are investing very heavily by themselves, with other banks in various kinds of consortia that are forming. And the reason is exactly what you put your finger on just now, which is that originally what people thought was a sort of a peripheral, private money, cryptocurrency, Bitcoin, not going to go anywhere or just be on the sidelines. People have realized that the underlying technology there, the protocol that runs Bitcoin, is either itself going to become incredibly important or another protocol, a rival protocol, Ethereum, for example, which you could think of as being separate, or you could maybe build it on and link it to the Bitcoin protocol, or another protocol along the same sort of lines, that something like this will become really important in financial market architecture and also in the way we pay for things. So there's the buying and selling of securities. There's also how I give you cash or how I buy services from you or how I pay for a cup of coffee. All of that is in play right now. And it's obviously, the good news is the central banks are, on this. They're running hard to catch up like the rest of us. Anything that changes this kind of fundamental architecture has got to have implications for the monetary system and for monetary policy and for the broader macroeconomy, including is it stable, do we grow, and so on. So I think the central banks see this very clearly right now. there are a lot of open issues about what should be the regulatory approach, what should be the approach of central banks. But these are all issues that we can and are working on as a community.
And of course, cybersecurity is a major concern for everyone at this point. And so how much does introducing new technology mitigate risks versus introducing risks? Of course, with new technologies come new challenges, and I guess the narrower the body of people that have the specialized knowledge, the more potential risk for, for kind of hacking or other types of kind of attacks. So where does this cybersecurity issue fit into the
Well, it's clearly a massive issue. Now, I'm not a cybersecurity expert. I talk to many people who are, and one of the points they make is that the internet, after 20 plus years, still has some substantial cybersecurity issues, but we can't live without it, right? And saying that we're not going to go in a certain direction because we're worried about our data being compromised. Well, frankly, our data are being compromised on a daily basis by our existing architecture. We are living with that not very comfortably. We need to do better. And that raises a whole set of issues about, for example, privacy. Who has your data? How is it protected? Why do various intermediaries, like the people you shop with and the people you do your social media with, why do they own so much of your data and lose it sometimes, or lose control over it? Why shouldn't that data be controlled more effectively by you as an individual? And what would that mean? How would you ensure that? These are super important and very hot topics right now.
And lastly, regulators and folks at the Federal Reserve thinking about economic growth and kind of the underlying weakness of the economy often talk about the need for job retraining for folks whose skills have become obsolete. It seems like this new technology is going to require some retraining for regulators themselves. I mean, are they going to have to become suddenly tech savvy? Is there a whole new host of expertise that folks employed at places like the Federal Reserve and other regulators are going to need?
Yes, of course. and the good news is that they're working on that. The world is changing. The world is changing very fast in this tech space. And we all need to follow that and understand it and catch up as appropriate. I do not hear any regulators, certainly not across the industrial world, saying no to this. I think that would be like saying no to the internet in 1993. Perhaps you could have slowed it down in 1993, but looking back, would that have been a good decision? Would your economy have done better if you said no to those jobs or no to that kind of technology? On the contrary, I think people would like to be hubs for the development of sensible ideas that are implemented in a way that respects consumers, in a way that doesn't damage, maybe helps financial stability, and in a way that can be shared or, if you like, exported to other parts of the world. So I think that really is an opportunity, and in 10 years we'll look back at this and say, okay, this country or that country made a smart early move, both in terms of private sector investments and public sector initiatives or approvals or not getting in the way. And that combination has led to the following really good jobs and prosperity in the following places. And that will be retrospectively how we see this. Obviously, we're in the moment right now, and so there are a lot of hard decisions to make, but one way or another, you have to make them.
Great. Well, thank you so much. I'm glad regulators are catching up, and I'm glad we have you here so that I and our viewers can catch up, because it's fascinating but daunting stuff. Thank you so much, Simon.
Thank you.
Appreciate it.